Here's a take from Bank of America on the gold price. He writes the following, Francisco Blanch: as central banks and governments double their balance sheets and fiscal deficits respectively, we have also decided to up our 18-month gold target from $2,000 to $3,000 an ounce. Francisco, $3,000 gold. What's the driving force behind that call?
Hey, Jonathan. So there's three things really to keep in mind, right? First of all is fiscal policy is extremely lax. Every government is essentially monetizing that debt through monetary policy. That's the second reason. And then the third reason is bank deposits are ballooning and investors don't really know what to do with that money. So if you put the three together, right, extremely lax fiscal, extremely lax monetary policy, and a huge increase in bank deposits, I think there's a pretty good chance here that we'll see a big rotation into gold, driving prices a lot higher. Investors are confused. They don't know what to do with their asset allocations. And I think that a lot of them will end up choosing to go for the yellow metal as an alternative to cash in their portfolios. And that's ultimately what I think is going to drive this. And by the way, when I say investors, I don't mean just retail investors. I also think institutional investors are going to make that choice.
Francisco, what's interesting about this moment are the parallels between now and coming out of 2009, where we saw gold really take off because of similar reasons. And I'm just wondering what the parallels are now versus then, and whether the narrative is slightly different in some way, shape or form.
Sure. I think the narrative is different because I think this crisis is multi-staged. Back then, you could argue, the crisis took a while to play through, and the Fed took a long time to respond. This time around, the Fed has done in 18 days what it took almost 9 months to do back in 08, 09. So everything is happening much faster. The one key difference, I think, is that we are looking at a major productivity loss longer term from all these disruptions. And by that, what I mean is we're going to have to retrain millions and millions of workers around the world. It's going to take a very long time to do that. And by the way, remote learning probably works for some parts of the population, not for others. Connectivity matters. So ultimately, we're seeing a big discrepancy from kind of the high-end sophisticated economies and the less sophisticated economies. So in the end, and the same thing applies to sectors. So what central banks are doing is they're using monetary policy and governments are using fiscal policy to address what's essentially a massive productivity dislocation, which ultimately I think is what's going to lead to inflation fears. And ultimately, it's also going to lead to very negative real interest rates, Jonathan, which I think is what's going to really drive gold. We'll see negative real rates at -3, -3.5% eventually, in our view. That's the big story.
Well, Francisco, this is really important because this will make the move much more durable than what we saw coming out of 09, which, of course, faded in the back end of 11 going into 2012. And I just want your thoughts on that, why this will be so much more durable than what we've seen before, and whether more and more people will start to get behind that view, because I think that's the question mark on gold right now, that some people feel like, Francisco, they've seen it before. They saw it out of 09, balance sheets carried on expanding, and then gold faded even as balance sheets as central banks carried on expanding. Just get the sense from you, Francisco, you're saying this is very different, a much more durable rally is starting to build.
I think so, and again, of course, maybe in a month or two, we have a great vaccine or a great cure to COVID-19, and this is all behind us. But even if that was the case, it would be extremely difficult to pull back all that monetary easing over a short period of time. So we've increased monetary policy more so than at any other time in history, number one. Number two, we seem to have a shock that is likely to last. I think economists around the world are saying that the unemployment shock is going to last for several years. It's not going to come. The job report that you mentioned yesterday, that you just mentioned for tomorrow, is very important. But I do think ultimately that the real issue at heart is that we will have to deal with a massive dislocation in employment because many of us will probably not make it back into the office for quite a long time, and that means also a lot of jobs will have to vanish. And as some jobs come back, Airbus, as you know, announced yesterday that they will reduce jobs by 50,000. So the high-quality jobs are going to be hit right now, Jonathan. I think first we saw the service, lower-income service jobs, and now we're going to have the full wave here. So this is a long-term trend, and I suspect that governments will have to keep printing money, and central banks will have to keep buying all the treasury securities and all the debt that is being issued. And that also, by the way, will have a long-term impact on productivity. These bloated government budgets will limit our ability to grow at the rates that we had been in the prior decades. So I think that's another important reason to believe gold prices will go higher.